Hi, welcome to this week's weekly market update here at Morton Brown Family Wealth. I am Katie Brown and I have Cody Demmel with me here today. Hi, Cody.
Hey, how are you?
Good, good.
Good.
So we want to cover a couple of different things that caught our eye over the past few days. The first one is a look at structured notes and how those have been playing out in this market environment and how people are thinking about those perhaps going forward. Then we want to touch on corporate bond issuance and how some of those the records for issuance have been smashed in this recent environment. And then we want to touch on unemployment benefits and where we stand on the payouts for Americans. That being said, we have a couple of, we want to make sure to start with a little bit of a positive note and provide some silver lining at the end of today as well. So to kick us off, Cody, why don't you give us an update on where the market stands and what's been going on?
Yeah, so some positive news is all the US markets have rebounded around 40% from the lows that we saw in the end of March, which is great news. And now the NASDAQ is actually positive 8% for the year. The S&P is only down 4% for the year, and the Dow Jones is down around 8% for the year. So we've had a very nice bounce from the lows that we saw in the end of March.
Yeah, I think for people that have been patient and have continued to keep their eye on the long game and didn't overreact during some of the initial turmoil that we had, I think they're being rewarded at this time. It's
a
great reminder of things can rebound almost just as quickly as they drop, and it can go in either direction. I mean, we never know what's going to happen, but patience is sometimes the name of the game.
Yep.
So the Wall Street Journal, some of you may have seen this article, but the Wall Street Journal had an article this past weekend, and it was titled "Bankrupt in Just 2 Weeks." And the article was primarily around structured notes. Since 2008, the market of structured notes, and I'm going to talk about that a little bit, has really boomed. It's now a $7 trillion market. A lot of that is filled with exchange traded notes. For those of you that might not be familiar, they are very complex investment strategies. One of the big differences is an exchange traded fund owns an underlying asset. And so there's an asset there. An exchange traded note is a debt instrument. And why that's important is that whoever issues it can basically shut it down. And that's been one of the challenges with this environment. What this article highlights is, once again, how complex some of these instruments are, but also how they were positioned. So they were positioned with the intent to provide a really high income stream. And in some cases, I think that they were positioned that it's investing in real estate, it's investing in other things that may otherwise feel a little safer. And so almost getting that income with low risk, where in fact that wasn't the case. There was a significant amount of risk because they were also leveraged, meaning that they borrowed assets to support the structure. And so some of these were touting 18% returns in a market where you couldn't get 18% returns, of course, without taking on that risk. And so it just created a very volatile place when things go south. And that's exactly what happened. So Cody, what were some of your thoughts on that article?
Yeah, it was unfortunate to see that some of the investors invested into it thinking that an 18% interest rate was just a way to get basic income. I mean, if you're getting 18% in interest, there's obviously a reason why you're doing that. And like Katie just put out, it was a leveraged ETN. So this one was actually 3 times the rate of what the underlying asset was doing. So say for an example, if it was tracking the S&P, if the market went down 5%, this was going to go down 15%. So when we had the volatility in February and March, a lot of these ETNs where the market went down 30%, these went all the way down to pennies on the dollar, and the bank was able to call back the ETN. Unfortunately, like the article said, some investors went bankrupt.
Yeah, it's really sad. And I think We're constantly talking about diversification and constantly talking about understanding your level of risk, not only where your comfort level is with the risk, but what risk you may have inherent in your investments. I think something that was really telling about this article too is that they talked about how a lot of institutions wouldn't touch these products. And if you have institutions where you have very bright advisors looking at it and saying it's too complex for us, then it's probably too complex for the retail investor as well. And I think that we're going to see a lot of blowback on that. I mean, there's already been some cases where, different companies that have sold these. A lot of the large brokerage houses are under fire and have been sanctioned before for not having proper disclosures on the risk levels of these investments. So it is, everybody's looking for that opportunity to boost yield and to build in more income. But it's a good reminder that high returns don't come with low risk. There's always a trade-off.
Yeah, exactly.
Yeah. So making sure to work with, that fiduciary and advisor that's going to look at it and say, okay, is this a good fit for you and your family?
Yep.
Yeah. So how about the Bloomberg article on U.S. corporate bond sales smashing records, soaring over $1 trillion? You want to give us some highlights on that, Cody?
Yeah, I saw this article earlier this week that so far in 2020, we've already passed $1 trillion in new corporate debt issued. Usually we don't, the last 7 years, we've issued over $1 trillion every year, but normally we don't hit that mark till November, December. We hit that mark in May. A lot of the reasons why we hit this was obviously for the pandemic. Corporations were trying to get the cash just to make sure that they made it through the pandemic. But then there was also some positive companies that were taking advantage of the low interest rates that are currently out there. On Monday, Amazon actually issued $10 billion of bonds, and for their 3-year bond, they actually set the record for record low corporate interest rates, and they're only paying 0.4%, which I thought was fascinating.
Wow. That is interesting because, there's two sides to that. There's the investor that's willing to purchase the bonds and build some stability into their portfolio. And then there's the companies that are growing. And for a company that is taking advantage of this from an opportunistic standpoint, and that may be a good, stable company, that could be a great way to reinvest. But I think the thing that we need to make sure that we keep an eye on are the companies that are issuing this debt to stay afloat, and what does it look like on the other side as their balance sheets expand? Can they keep pace with that debt load, or are we going to continue to have kind of that big balloon with those bond ratings that are sitting at the BBB that are just barely above junk grade? So more than ever, it's going to be important to make sure, once again, that we crack open what's owned inside of the bond portfolios and make sure we have all the risk. Yeah, but that's fascinating how much debt has been issued, and I think it also plays into the mergers and acquisitions market too. I think the initial assumption is that business is going to stop, and that's not the case. It's continuing to grow, and yeah. So then, lastly, we had an article once again from Bloomberg that talked about 1/3 of America's record unemployment payout hasn't arrived yet, and there are a lot of people that are still waiting for those unemployment checks and that boost in the unemployment check. That extra $600 a week, unfortunately, hasn't landed in the homes yet of a lot of Americans, and I think the article was interesting because it highlighted some of the challenges in getting the money there, some of the challenges with even, the state systems not having enough staffing to go through all of the applications, being so inundated by the record numbers of unemployment claims, and just getting through everything and getting the process started and getting those checks out. But that creates stress on the Americans that are depending on that. And they hear it's coming, but it's just not there yet. what were some of the things that kind of caught your eye there?
Yeah, I mean, that's obviously very unfortunate that a third of the unemployment hasn't been able to be processed yet just because of the heavy overload. I thought one of the shocking but unfortunate numbers that were in the article is the expected jobless rate for May is expected to be 19.5%, which is the highest since the Great Depression, which I just thought was very shocking and unfortunate to see.
Yeah, yeah. We're still seeing those numbers continue to increase. But on the positive side, you saw something else with Lyft, if you want to.
Yeah, so it was positive to see that Lyft was up 36% in rides over the past week, and hopefully that is showing that the economy is opening up, and it keeps increasing over the next couple weeks and the summer.
Yeah, I know we're all excited here for the restaurants to start offering outdoor seating and looking forward to, I think all three cities now are lining up, Allentown, Bethlehem, and Easton, to kind of shut down the roads and give people a little more room, and definitely looking forward to getting some of that normalcy back. All right, well, one last note for everybody today. We just really want to recognize that 2020 is a tough year for a lot of people, whether you're impacted with the coronavirus, whether you have job loss or impacted, some other way with this economic shutdown, or if you're impacted with some of the turmoil that we're seeing in a lot of our downtowns right now. Our thoughts are with you all, and we really wanted to make mention that we care deeply about what's going on, and like I said, we're all here with you. So thank you so much for tuning in today to the Market Note. We really appreciate it, and we always welcome any questions that you might have. Please feel free to reach out to any one of us directly or to our office in general, and we'll look forward to connecting next week. Take care.